what we've implemented over the past, I'll call it 6 months for our deals is if we have a conversation, it's a summary of the conversation with the construction manager or the operations team or the leasing team or the property management team in general that covers what we have, just so everybody knows nothing gets lost in the cracks. So it's making sure every single task and every discussion with our business partners are tracked and there's an actionable item from there.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Brendan Chisholm is a principal at BKC Holding. They currently have 169 units in assets under management. He capital raises for value add and distressed properties in multiple Southeast markets. Brendan, welcome to the show.
Thank you, Sam. It's a pleasure to join the show today.
Absolutely. The pleasure's mine. Brendan, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Where did I start? 90 seconds or less. All right, here we go real quick. About 10 years ago, or right when I graduated college, 14 years ago, all I wanted to do was climb a corporate ladder. Didn't want to do that anymore, so decided to think real estate was the best way to do it. I started looking at turnkey passive single-family homes in the Southeast and migrated myself up. When I realized that didn't really turn equity or turn money as quickly as possible, started looking into multifamily. After that, just really jumped into it for a couple of years before acquiring my first property. And then where are we now? As you mentioned at the top of the show, just purchased my third property in under 21 months. And that is the plan. The snowball is officially rolling and keep on keeping the momentum going downhill.
Man, that's cool. 3 properties in 21 months. That is momentum. That's absolutely momentum. It takes, especially when people make the leap into bigger assets. I think it's commonly underestimated the amount of time it takes to get your first deal. I mean, was there an on-ramp period for you, or was it just, hey, we're going to multifamily and you just started acquiring things?
It was an on-ramp period. As I mentioned, I wanted to look at turnkey rentals because I thought that would be the easiest path to do, at least cutting my teeth there. Then I started reading up on bigger pockets. This was 4.5 years ago, maybe 5 years ago at the time, and seeing what I could do. They're like, all right, go to a investor meetup. And the first or second investor meetup, there was a gentleman there by the name, that started talking about multifamily and the power of the cap rate. And with my corporate background, I'm like, this sounds in theory just as easy as trying to buy single turnkey assets. Joined his mentorship program for a year and a half, and finally in 2021, February 2021, I, along with my investment partners, closed on our first apartment syndication. So that was my first real estate investment. And as you mentioned, now it's just been momentum and just sticking to it. This is all I focus on from an active perspective, and just keep at it and just keep my focus here.
Right. Hey, man, that's great. 1 every 7 months is fantastic progress and momentum. Nothing to be ashamed of, certainly on that front. When it comes to the types of assets you are buying, I know you and I talked a little bit here before we kicked this off, in that you're buying some assets and you're pumping a ton of money into these deals. Can you give me some kind of background on what flavor, I guess, of multifamily it is you're looking at and how you're finding value there?
Sure. Or the team I work with, we focus on value add distressed investment types. So the value add is putting capital expenditures into the deal and forcing growth in NOI, mostly through reduction of expenses and increase in income. We're going in, as you mentioned, it's a heavier value add deal. The first property that we purchased, put about $1 million+ into the property, upgrading the kitchen, flooring, bathrooms, everything, as well as the exterior to reposition the property and get it stabilized. The second one, similar strategy that we're implementing, in that second property is 70 units in Rock Hill, South Carolina, and we're doing a $2.1 million CapEx plan on that deal. Taking it back, I know. It's doing a combined $30,000 per unit on both the interior and exterior work. Uh, both these two properties, have put in or will put in barbecue units, dog parks, playgrounds, completely repainted the exteriors to give it, that fresh modern vibe. And the living units are, as close to, class A minus that you'll see. You go in stainless steel appliances, brand new, modern cabinets, modern design, to really capture the market down there, in markets that we see a lot of rent growth, income growth, population growth, everything that you're looking for in a multifamily acquisition at this point.
When you say value add distressed, what does distressed mean to you?
Distressed, under 85% occupied.
Okay.
9 of the units when we purchased the property were completely down and uninhabitable. So by occupancy level, based off of many consider some of the definitions of the multifamily, that would be what we consider a distressed deal. If it was fully, if it was stabilized above 90%, or some may say 85%, it could have just been that value add strategy. But we're ultimately looking at putting in, based off of the unit count, $20,000 to $30,000 plus dollars per unit.
Right. And under 85% occupancy doesn't necessarily scream distress to me. Obviously, there's some operational improvements that might need to occur. Or there could be some strategic reasons why that occupancy is lower. Are you buying like class C or class D? I mean, pumping $30,000 a unit, that's a lot of loot to throw into every single unit. I mean, can you give me some more color on that?
Sure. These are class C properties or class C assets that we're transitioning into a class C plus B minus asset. Most of the vintage that we're working with is early mid 60s, early 70s properties. 2 of them are 60, 61, 65, and the others are early 70s product. A lot of the interior units have been remodeled before, but had more of a 1990s feel to it. Although a 90s kid, I don't really want to make sure that we're trying to increase rents by providing that type of product to people. So that's where I think that answers your question, Sam, of what we're looking at from when we purchase it, as well as what the units will look like post renovations.
Yeah, absolutely. Go back a couple of years. What are some things that maybe you're doing differently now than how you were doing them 2 years ago? Or I guess the other way to ask this would be, are there some lessons learned that you would say?
Yes, definitely lessons learned. And it's
changing.
Yeah, we've done some things, when we first acquired the property, of looking at what our CapEx budget would be, going on Home Depot, going on websites to find what the cost would be, and then try to assign that to a cost per square foot. So in our underwriting now, that when we're looking at our underwriting, we're taking the actual cost that we've got back from our contractors and being able to apply it on a per square foot basis. So we're seeing how much money it would actually cost, so we can be more in tune with our underwriting. One of the other things that we've implemented is interior and exterior trackers for every single project that we're going through. These are large capital expenditure budgets, so with a lot of different moving pieces to it. And there could be 20 different items that we're looking to do on the exterior or need approval for on the interior. So we've created spreadsheets on our team to see where the status is of if we're going to do like regrading or landscaping, who's making the calls to the landscape architect? Where does the bid stand? When was the bid submitted? What's the turnaround time? Just so we have more informed asset management calls with our property managers, with our construction teams. And since we're managing in multiple markets, there's different property management companies. So we don't want to have a blur between each deal. We're asking for this could be something that's going on in property 2 instead of property 1. So it just helps us stay on track with it too. And it's simple to say, but what we've implemented over the past, I'll call it 6 months for our deals, is if we have a conversation It's a summary of the conversation with the construction manager or the operations team or the leasing team or the property management team in general that covers what we have, just so everybody knows nothing gets lost in the cracks. So it's making sure every single task and every discussion with our business partners are tracked and there's an actionable item from there.
How are you tracking those? Is that via follow-up email? Is there a platform you're using? Who is writing down the meeting
minutia? Yeah. It's first email. Then I use Monday.com, and it helps tremendously with our follow-up and who's the person assigned to the task. And then it's just, we share a OneDrive amongst our team, and we have all of these trackers assigned that we've created for each property. And whoever's in there is looking at it, updating it, and then just updating the date on which we have the discussion.
Right. How have you guys, you're taking down deals as a team. How have you decided who handles what part of this business?
That's evolved over the past 21 months as well. The majority of us, when we there were 6 GPs on our first deal, and that's a lot of hands on a 53 unit deal.
Sure is.
So it's evolved in which each of our strengths are, we figure out what our strengths are, what we like to do amongst, now there's 4 of us who are working together. Who likes to do the asset management, the follow-up? I'll raise my hand. That's me. There's other guys who focus more on the acquisition side to allow us to get those 21 units or the 3 properties in 21 months. And all of us separately focus on, our own group of investors to be able to do our capital raises, market ourselves, market what we're doing. But one person's more so involved with that on the retail side, where for us, it's more of just internal family and friends that we're trying to recruit to invest into a deal.
No, I think that's great. I think that's always an interesting, just the relationship and how those are built out. Because a lot of times we see that here in the space where there are multiple people with multiple different entities coming together to take down a deal, which is one of the cool parts about this business. But then deciding who does what and making sure that everybody stays on track is a unique, not problem, but just thing to be solved, I guess. And
right.
And how people solve that and take them down is always probably unique to those particular sponsors. So curious, how that worked out for you guys. What do you see in the acquisition pipeline or in the acquisition future, for you guys? Is it going to be more of the same? Are you guys changing what you're buying? Talk to me about that.
We'd like to graduate ourselves into larger deals. So the most recent acquisition, it was a 45 unit direct from seller off market. And it hit our return metrics. It hit everything that we were looking for. But prior to that, we were looking at 75 to 150 units in the same markets that we currently have properties in, just to see if we can start cutting our teeth there. We'd like to get somebody who's a full-time leasing. We'd like to have a full-time person and full-time maintenance and leasing person on staff, and then start building out some of the economies of scale on our end there. We're still focusing on these value add deals as well as distressed. It's in a rising interest rate environment where rent growth has, it seems like it's finally slowed down a bit, just month on month, not year on year. However, our business plan prior to the tailwinds that we've received from some of the rent growth was to add value to every single deal by increasing the rental income, figuring out if there's additional ancillary revenues that we can generate and creating operating efficiencies. And we still think our business plan, through what we've seen over the past 6 months, going over the past now until whenever, it's just to continue buying value add distressed deals and forcing that appreciation on the property.
You mentioned some team members that I would have traditionally thought were part of property management. Are you guys in-house managing, or do you guys have third-party managers on each of these properties?
We have third-party property managers on all of these properties. We don't have the scale yet in our local markets to be able to do a full-time property management team yet.
Got it. Got it. Okay. Okay. Very cool. And I guess that's the next part of the business is when you start buying bigger assets. But what are you guys gonna do, you think, to stay competitive when you start buying bigger assets?
How do we stay competitive? Just it's through those seller and broker relations that we have. I'm not saying we've gone out and acquired more properties than anybody else, but we make offers on deals and we've proven we can close on them. So, and right now, we're gaining a track record of doing well and hitting our business plan. So I think it makes it when you present that to a broker or a seller, there's a list of references that accompany each of our LOIs that go out that, hey, these guys actually can close. We've worked with multiple lenders now, both on the the agency side as well as the bridge side, that say these are the guys that can close deals. They go after deals and they deliver upon their word.
I think that's fantastic. You mentioned something there I'm really curious about is the debt side of things. What do you see on the debt side? How are you guys positioning yourselves right now as it pertains to debt? Is there anything unique you guys are doing?
I wouldn't necessarily call it unique. So we're adapting to the changes of what the debt market is giving us.
Right.
And our first two properties that we acquired in 2021 and early 2022, we did we're doing a bridge to agency loan. We've executed upon the first one. We got the long-term debt set up. The second one, with the floating rate debt, interest rates are going up. However, we accounted for that when we purchased the property. We've worked with our lender to make sure that there's a cap on SOFR right now. Ultimately, what I'm trying to say is we've transitioned into our third deal because we bought a fixed loan, or we got a fixed loan from a community bank rather than a bridge loan. We saved 200 basis points by going fixed versus a floating rate. So there's some meaningful difference in having that for your monthly debt service than what it would have cost us if we went bridge.
Yeah, 200 basis points. That's substantial. What was the downside? I guess when they said, okay, there's always the bait and then there's the hook. So
right, the bait, the hook is it's a recourse loan. However, we feel collectively we feel in our heart of hearts and in our belly that regardless of what's going on, our business plan and the way in which we execute it is sound. And we were okay accepting that type of, with recourse. There has to be a zombie apocalypse for us to, for like if our break-even occupancy for that property is 65% on like a law, over the course of many months that happens in the market that we just purchased it at, based off of how quickly they're turning units and how low the days to rent are. There's a lot more going on in the world than worrying about our property being 65%.
And I'm sorry to cut you off, but assuming a recourse loan, everything we do in the RV resort space is recourse. Yeah. It's just the way it is. There's not the option for non-recourse. So I don't know. That just if you're not willing, this is my contention, is that if you're not willing to go recourse on it, then you probably shouldn't be doing the deal.
Right.
I mean, either you believe in it or you don't. And
that's a big thing. We believe in it. We believe in every single deal we do. We invest right along with our limited partners, and we're putting our money where our mouth is. The second thing that they put us with was the prepayment penalties are a little higher on the first 3 years. So it's a 3-2-2.
Right. Okay. So for 3 years, you have a higher prepayment penalty. But again, if your business plan is longer than that.
Yeah.
Okay.
Our business plans usually are, 7+ years hold and do the execution within the first 18 to 24 months.
Right. No, that makes a lot of sense. Brendan, that's super cool. I love the way that you guys have found a way to get into some of these, I'm going to call them smaller deals initially out of the gate. Some stuff that needs some heavy value add. You guys haven't shied away from that. You found a way to pump a ton of money into the deals and yet still have them make sense. And I think one of the things that we talked about off air, maybe we didn't get to chat about here, was just, and I know you briefly mentioned it, is that you've had a refi on one, if not two of these properties go down, and it's come out looking very, very nicely for you and for your investors. So I love the way you guys have had such fast progress here in the last 21 months, and then looking forward where you guys you're looking to do larger deals here in the future. So that's absolutely awesome. If our listeners, Brendan, want to get in touch with you or learn more about you, what is the best way to do that?
Sure, Sam, I appreciate that. You can reach out to me at my email, brendan@bkcholding.com. My website, bkcholding.com or brendanchisholm.com. Love having conversations about real estate and what's going on in both the debt and equity markets or just general operations. So feel free, if you just want to talk, just to give me a call.
That's awesome. We'll certainly put all that information there in the show notes as well. Brendan, again, thank you for coming on. Certainly appreciate it.
Appreciate it, Sam. Have a wonderful day.
You too, sir.